Good morning, traders. Welcome to the Flow Show, back from our little bank holiday yesterday. Ready to get stuck into things. The last week of the UK, a lot of Europe summer holidays as well. So then we're going to be back with a bang from next week. But still some stuff to get through this week. Anyway, morning, Kay. How you doing, mate?
Morning, Ryan. Morning, everybody. Yeah, I'm doing fine, mate. I'm doing fine.
Good. Navigating Powell and everything okay last week?
I'm sorry?
Navigating Powell and everything last week
okay?
Yeah.
The pound is doing really nice things, right? As I said, I mean, we are in full UK exceptionalism.
Yeah.
Well, let's enjoy it while it lasts.
Exactly, as long as it lasts. Just before we kick off, you'll notice there on the screen the trader coaching website. If you wanted to have a one-on-one session with K-Man or myself or any of the other members of the team pictured there, you can do so. Don't forget, you can get 40% off your first session with any of the coaches you choose. So you can take advantage of that. But anyway, let's get stuck into things and see what's going on. Going to start with a bit of data out of Japan overnight. Bit of softness in the corporate PPI index, coming in at 2.8% lower than the 2.9 expected and 3.1 prior, which was revised up. Also, this Bank of Japan, they've got a core CPI measure out that came in softer than expected as well, 1.8% versus 2.1% expected and prior. Don't know if market's really paying attention to that number exactly, but still a little bit of a soft one when they would be hoping to keep the numbers up around that 2% target. Any thoughts on that data, mate?
Well, first of all, that BOJ core CPI is food and energy, and those are the two things that are keeping the rest of the CPI data up. So yeah, okay, there's probably a bit of housing in there as well. No, I'd say really, yeah. I mean, they could use it as an excuse for something, but UADA having been relatively hawkish and brushing any complaints under the carpet regarding the rout in yen and things. I don't think it changes the overall picture much right now. Yep, I'd rather look at the other number than the PPI. Yeah, if that continues to come down, that may be a more interesting one, because that englobes a lot of stuff that is directly related to the day-to-day life as well. So that may be actually a more interesting one right now, but it's still well above their 2%. So I'd say all in all, move on.
Yeah, very much so. That PPI number, well, it's a weird one. It's the corporate services PPI. So it's not like manufacturing and that sort of stuff.
No.
Bit of a weird number, that one, to get your head around. But just follow the trends, probably the way forward. Right. Moving on to the Riksbank, they had their minutes out yesterday. So we got the various voices giving us their be all and end all. Janssen said he would back larger cuts if new information supports it. Bunya said can cut rates at somewhat faster pace than seen in June. Had a moan up about the SEK exchange rate is somewhat weaker than they are forecasting. And then, so there's a bit of a battle between the Doves and the Hawks. Thieden said there's no reason for larger individual cuts. Bremen said 25 pip cuts are well-balanced monetary policy and gradual moves are more predictable for households. So a little bit of a split there in the Riksbank over whether they should go for bigger cuts. So that's the territory we're getting into with a lot of these central banks at the moment, not whether they're cutting, but how big they're going to be. Germany had some data out as well. We had the IFO business climate I can't even say it, business climate index for August, and going the other way of what we saw from the Zoo report. A bit of a gain in the headline number to 86. What's that? I can't even read it. 85 sorry, higher than expected. Also, current conditions coming in, confirming a little dip from the 87.1, but expectations as well also showing in the green. So a little bit better there from these German numbers, as I say, compared to the last zoo report anyway. The only data of note from the US yesterday was durable goods, which came in on the headline number a healthy 9.9%, but we did have a big down move last month. So big expectations as usual. A lot of big ticket items seems to be what's been going on in there. Transport, manufacturing, capital goods all had big turns around. For example, transport equipment rose 35% versus a drop of 21%. So there's some pretty big swings in that. The core goods, if you like to call them that, which is capital goods orders, non-defense ex-air, that came in at minus 0.1%. So that makes it, from the consumer side at least, a little bit softer looking on those numbers. A couple of Fed heads have been out. They're all starting to get around the Powell chair, shall we say. Barkin says current low hiring, low firing approach that firms are currently taking to employment is unlikely to persist. The risk of firms resorting to layoffs grows if the economy weakens. It says disinflation has spread beyond goods to the rest of the economy, boosting confidence it will continue. So he's sitting on the fence looking potentially for this low hiring to switch to firing. Fed's daily has had a bit of a change as well. Says it's hard to imagine that anything could derail a rate cut in September. The time to adjust policy is upon us, taking Powell's line there. It's too early to know the size of rate cuts, but says it's reasonable to adjust policy at a normal cadence if the economy develops as expected. Doesn't want to keep making policy tighter as inflation comes down. Says the labour market is in complete balance and not seeing any signs of abrupt weakening. Again, not hearing signs that firms are paused for layoffs. Okay, just going down to the Powell stuff. It's nailed on pretty much, isn't it now, the cuts, likely for September. We've got PCE this week, but I don't think that's going to derail it at all.
Nope.
Really, all we're looking from sort of fresh eyes is that we're just going to be playing with it. It's going to be 25 or 50.
Well, that's exactly what I've said over the shows, Ryan, while you were off a couple of days. The next employment report is probably going to be the decider, whether we do 25 or 50. And listening to what Powell said, he's now like, they seem to be relatively happy with what inflation is doing and where it's heading to, although the usual could be bumpy warnings, which is possible, even if it's taking the direction, and we've not seen, and that will take time. And I don't think the move has been big enough. Although if you look at the yen, of course, it's been a huge move on the dollar. But whether the weaker dollar will have an impact on inflation, I think that's going to have to wait a few months. But I mean, it's the next jobs report is going to decide whether we get 25 or 50, and that is how I look at it, and how I potentially plan to trade it. Get a very weak one, then I think we may have a bit of a remake of 2023, even though the dollar is now already weaker, where it was stronger going into the last quarter last year. But if that jobs report is weak, then we may see a weaker dollar all the way to year end, and we may get that 50 VPs cut. But until then, my base case for now is it's going to be in increments of 25s, and unless the jobs market completely drops away.
Yeah, and I agree with that. I'm going to play a bit of devil's advocate here, and a bit of a spoiler, because I've just done the trade-off with Michael Brown, and I said the same thing as well. It's obviously all the focus on the jobs market, but the jobs market weakening doesn't necessarily mean that the economy is weakening that much. Obviously, it is an indication. jobs are being lost, that suggests weakness. But if you take everything at face value, still strong GDP growth. The Fed cutting rates against the job market doesn't affect the jobs market per se. Okay, it affects the economy, not the jobs market. Now, by definition, strong economy equals strong jobs. I guess what I'm getting at is, even if we do see a weak jobs market, is that not just a bit of a pullback from the strength it's shown since COVID? Should we not expect it to go the other way for a little bit to come into better balance? So if we see a stinky NFP, what's a 25 or 50 pip cut going to do to it? It's not going to change it from the next month.
No, but no. But well, I mean, that is obviously there's not one side to everything. But where I would say is that for the value of the dollar, a weaker jobs report is probably going to get the market betting on at least one, also 50 BPs, and we know that it affects the value of the dollar. So whether it's the case of weighing or impacting the economy or the jobs market directly, we have seen that big revision. So that means that the BLS numbers have always been overstated, which was already showing in the household numbers, right? No, I think the impact, whether you have like 2% growth like we've seen yesterday on the nowcast or whatever, it's the dynamism in the US economy, and there your job market is probably more important than doing a 25 or 50 BPs cut, well, which will be the result of. So whether it has a direct impact on the economy or not may not be that important for an investor. The investor will see, like, are the bonds going up or down on a 50 BPs cut, and do we want to keep dollars if the Fed is cutting now faster than for instance the ECB or the Bank of England, just to name those two, and that's where it'll affect the currency, right? And yeah, the market has this bone between the teeth, and it affects so many things. What the Fed is doing, that yeah, the direct impact may not be as important as the impact for us, for what else are concerned, of course, on the currency. And now I'm going to come your way. How much has the market already traded of it? That is going to be the question, to which we will probably have an answer on the next jobs report.
Yeah, no, I think I agree with that. We've potentially got a bit of a last hurrah in the dollar, potentially, I say, after Powell confirmed what the market's been chasing all year, and it might be the same with the jobs market. The first bad jobs number may be the worst market reaction if the jobs market is turning sour. But I think that the risk is that the market and everyone gets too hyped up about jobs and rate cuts, tying them together. If the jobs market is going to turn, it's probably going to trend lower. Okay, so even if they do start cutting rates, it's not going to turn things around for months. You don't cut rates and then someone who was just about to sack someone turns around and goes, "Oh, we've got a 25 pip rate cut. I'm not going to sack anyone. I'm going to start hiring." That's not the way it works. So I'm just urging caution against tying rate cuts to what happens in the jobs market.
Yeah, but the thing is as well, Ryan, and what comes in the market now. Recall, we have been talking about it, and I've been saying, like, okay, the second half of the year we will probably start to see a clearer, and actually we have to, and whatever the market thinks about Powell, and that's what I always say. Like, I mean, to me, a central banker is a central banker. Okay, Bailey is a special case, but a central banker is a central banker. I'm not going to say they're wrong or they're right. They just, we react to what they do, which could be a good thing or a mistake, And it has to be said that Powell has been warning since what is it, somewhere in May or June, June, I think, during an ECB thing, that he saw things weakening, and he has been saying that they will support the a weaker jobs market, or try to support the economy by then reacting. And now we're coming around to that. So yeah, there is probably going to be a big reaction if we get that weak jobs report and repricing again of expectations, because I think right now we are not expecting not overly expecting the 50 BP cut. It may gone up a little bit again, but we're still only at about 30% or so, expecting for a 50. That is probably going to be impacted by the next jobs report then.
Yeah, I think so. And it could just be a bit of arse covering, keeping 50s on the table covers their arse. If the jobs market doesn't collapse as expected, then they can just cut at a more varied rate. So again, this goes back to how they got caught out with inflation rising previously and having to hike fast. Now they want to make sure they don't make the same mistake on the way down by limiting their options again. So anyway, there's the rate expectations now. So yeah, 28% chance
Actually,
of it cut.
no, I'm actually surprised we're back down to 28, because we went up like to 33, 35 or so on those big revisions that we saw.
Oh, well, the F.A.C.E jobs revisions, that was
Mm.
hilarious. That was funny last week. Anyway, if I'm getting to that. Right, let's move on anyway. Got some geopolitical stuff to get on with. France is still bumbling along with a cobbled half government thing. They're just waiting to pick the PM or the Premier, whatever you want to call it. Le Pen has so far rejected the left-wing premier candidate. Macron's yet to put his own candidate forward, though he says he doesn't want a left-wing person in charge. So that's still bumbling along. I think they sort of cobbled together some sort of budget thing. I don't know how that's going to stand up to scrutiny, but anyway, that's still bubbling under the surface. Just to bring that to your attention. Over in Gaza, apparently progress has been made, or further progress has been made in the ceasefire talks, but there's work still to do, according to a US official. Pentagon spokesman says the threat of attack against Israel by Iran and its proxies still exists. Russia has apparently stepped up its retaliation for this insurgence by Ukraine. They've been sending tons of drones over into Kiev and surrounding areas, so they're stepping up things there. And apparently Zelensky is going to, or has presented Biden with targets it could hit in Russia. This is obviously they've already started hitting in Russia, but this is something that the West has been pretty much opposed to, particularly using their supplied weapons to hit targets in Russia. But as we've been saying for the last couple of weeks, this is taking a little bit of a step up in hostilities. So that risk is still bubbling around under the surface. Canada is pissing off the Chinese. They followed the US and slapped 100% tariffs on Chinese electric vehicles. China's Ministry of Commerce has urged Canada to immediately correct its wrongdoing. So expect some further lines, perhaps from China, impacting any Canadian trade along the lines. That's it for a rather quiet Monday. Kay, got anything you want to add?
Oh no, I think we've covered most of what's going on, right?
Yeah, pretty much, I hope. Anyway, right, let's get stuck into what some prices are doing. I've been playing pretty much a little bit of catch up. I was trading on and off throughout. As you can see, Euro Sterling there, my first chart, keeping an eye on that one because we've got a further breakdown. This was a bit of surprise to see it getting back under 85. I thought we might put up a bit of a fight on the move down, although I'm not complaining. I'm still short, and I've just slipped a bit off, as has Mr. K-Man. So we are heading down to this 84 area once again, and I think we're probably going to get a test of it. Now, a lot of this, I think, is, and Kay will correct me if I'm wrong, a lot of this is, again, that speed between cable and euro dollar, I think is doing for this at the moment. Some of that might have to do with euro dollar hitting this big 112 level that I've been banging on about for quite some time. Let's put on a weekly chart. So this is one of the big levels that we've got up here that's had plenty of action going back many years. So not a shock to see us running into a brick wall here. As I say, cable still going, euro finding it a bit tougher, euro sterling benefiting from that to the downside. So we might hit this 84 level, and I'm in two minds what to do down here. I'm obviously going to take some of my shorts off down here if we see it. But if we're down here because cable's still moving and euro dollar's stuck at 112, if I'm seeing around the dollar space, other dollar pairs legging up, breaking through highs, and euro dollar is looking the laggard, that potentially sets up a break, which might, in fact, solidify this support down here. So if cable, say, up at 133 Aussie dollars through 68s, that sort of thing, but euro dollar can't get through that 112, then that's going to get there. But the more the dollar weakens, the more chance that euro dollar will catch up. And if that happens, it could be a big break of the euro dollar, which would put the brakes on a further move south here. So that's how I'm looking at this one. But this move up here in euro dollar, a big level break there. I'm sure the rest of you guys have been looking at this 61.8 fib. If we get over that, we're looking at this 115 level, which is another absolute monster. As you can see, we're all the way back into the 1990s where this level has had saying things. So these are the big levels. This is going to indicate a break. I don't think for euro dollar we've quite got a break on yet. We've broken some of the range tops, 110, 111, but this 112 and particularly that fib is going to signify a proper break of this range that we've been playing here. And then we're looking at some big levels to the upside. So that's what I'm looking at for that one anyway. I still got a little morsel of Kiwi dollar on. And again, we're not quite breaking. We've got this zone up here into the 62 from 61, 90, 94s, whatever. So we've made the move above there. We're holding it. It's just come down to a short time zone. We're holding it as support. That's constructive. We're just starting to try and build some support here. We tried it the first time, failed. Trying it a second time. If we manage to build support here, then we're going to get potentially another leg higher, and we're going to be pushing up to the high 62s, 63s, and that'll be a break of this 2024 range that we've been sitting in for quite some time. So there's lots of pairs on the cusp of kicking on again. Dollar CAD, another one. I got in short after we had this bounce back. I pulled all my orders while we had all that mess with the revision and POW and everything. But that bounce into 36, I put in my sell stop again, 35.80s, and we've had a decent move. Again, we're just tapping around a zone down here. It's done what I expected to. When we got a proper break, it was going to go pretty quickly, purely because of just the weight of everyone buying up here, all the amount of stops that would have been sitting down there somewhere. But we're on this zone. It's going to need us to break this 34.60s area, push down to the 61.8 fib and maybe the 134 area. But you know where the main resistance is likely to be sitting now. You get a move up here and it holds, and that's going to encourage people to get into short. So decent break. That's why I love looking for break trades in moves like this. When you've had a decent amount of support over a good period of time, you know the chances are that when you get a break, it's going to have some legs on it. Another one, keeping a beady eye on, dollar China. And we haven't quite had another move down to this area, but we're still holding this zone down here. I am, again, contemplating whether this is another potential stretch trade to look at maybe longs there as we confirm that area, 710s, 709s, 708s. So I'm looking at that one, but it does look pretty weak. Again, largely dollar driven. So if the dollar does turn, this one could be another one I'm looking to get long. Again, Kay, I'm going to bet it over to you, mate. Because
you want to be long dollar China when there's articles on Bloomberg saying that $1 trillion may flow out of China if the Chinese come back with a vengeance. Ha ha! I mean, Ryan, what are you doing?
there's a
I
definite
found it
buy
really
signal
funny.
then.
I didn't want to mention it, but now you speak about dollar China, I just couldn't hold back.
Oh, I'm going to sit on my hands then.
There's
If
many
Bloomberg are pumping it, then I need to ignore it. Anyway, yep. Right, let's punch it over to you, mate. Give me 2 seconds. Oh, all my buttons have changed around. There we go.
Okay, I'm just going to repeat just one thing, that euro sterling, and then I'll look at some different things. Yeah, I'm still short as well, and you know, I mean, UK exceptionalism, it's of course half a joke. But I just wanted to remind everybody that if you look at the UK data versus European data, for instance, they have been continuously doing better over the past months. Okay, so there is we've had this like spike higher, big risk off, you name it. But then the market turned around and really was looking at data. Yes, we know that there's a risk in for the budget coming up, but that's still a month away, right? And also, I would like to point out that the market has been repricing some expectations for the Bank of England. So we find it back. Don't go blindsided on the Bank of England expectations, but the move that we saw in yields. And I'm just going to show you one little one here, and that is the 10-year sterling yields have been creeping up. Okay, they have been creeping up. So the market has been trading the sterling also on the better side, and I think that has to do with the data. Crunching the numbers, we know that Starmer has been moaning and groaning about the holes that his predecessors left and everything, but then the market turns around and says, like, wait a minute, I mean, the numbers perhaps not showing as bad a picture. So the sterling has been a currency that, in my opinion, has been now doing much better. It has been before as well, before we had the major blip, and now the market has just picked up on where it left before that big scare in risk and well, yeah, all things risk really. I do think that before we get the budget, unless there is some repricing to be done, unless the data turn negative, there is a chance that we are going to technically it's just a line, right? But there is a chance that we end up somewhere half 83s before we start to rethink what to do in sterling. And I do think that the rethinking in sterling will perhaps, and we were talking about that with Ryan as well in the room this morning, the rethinking will perhaps have to be done on that autumn budget, because we never know what Reeves is really going to come up with, what kind of tax hikes also could be in the pipe. So then we will need to rethink, but that's more of a medium-term consideration. In the meantime, we've seen those yields higher, and also attached to yields. And we know that the market has been killing off its carry trades, and the real high yielders have not been doing well, although we could argue that stuff like Rand, for instance, is actually doing a lot better. The only one really undergoing the laws of gravity has been the Mexican peso. But if you look at the global yield sphere, and especially the majors, sterling is actually not too bad a yielder. And if you consider, and that is probably why we are seeing these kind of price actions as well, and these kind of moves into sterling. If you consider that the US is turning around, or starts to turn around, people are adjusting their books, and sterling, if you also then look at the equity markets, is a beneficiary. It is usually when the dollar goes down, it's an accelerated euro, as we've already been mentioning, and Ryan also said a few minutes ago. But it's also, if you look at risk, equity markets are on the whole doing pretty well. Yeah, we see setbacks and we see up and down in the Max 7, whatever. But if you look at this as a whole, it's doing well. Sterling is a risk positive currency as well, and it's a relative high yielder. So there is there are enough reasons for now, compared to the risks, that sterling is doing well and may actually continue to do well. And I'm thinking about end of month already, and et cetera, et cetera. So those are the some of the reasons why I'm also still short euro sterling, because of the data divergence. Okay. All right, cable then. I know that Bran always loves to look at the cable, and we need to go back on a bit of a wider time frame. There is a bit of activity going on in up around 132 3/4, 133 if we get there. As I said yesterday on F.A.C.E, there's a potential, but we don't see it now, but there's a potential for we know tomorrow value date, end of month, there is potential for a little bit of a setback here, but I do think that towards the end of the month, we could actually go and tickle those levels. Of course, if you look at the speed of it now, we could be there in 3 hours. But I do think there is a potential to go and visit a bit higher in the cable still before the month is over. All right. Give me anywhere below 131.40 down to 131. I think it's we're already going to find plenty of buyers there. Okay, I know that a lot of people are always asking about what's going on in gold. Well, gold is not following that dollar move too much anymore, right? So despite the heightened geopolitical risk, whether it be the Middle East, whether it be in Ukraine-Russia affairs, gold is not following the moves anymore. So I've decided to really screw back on what I bought again the other day, and just wait for what's going to happen. Now, we know that there's now literally virtually $30 of, people could say, support, but equally, I think if we get down below 24.94, we could have like a revisit down there too. So there is a bit of a risk to revisit there, but let's look at where we are. And I would now say, let's look at where we are at the end of the month. I think that if there's really, like the models say, and they don't really model metals, but we know that clearly for the end of the month, we do have metals moving every month, okay? There is a potential for going the last gasp higher, but in the shorter term, I'm thinking that a lot of people are potentially already in position and just waiting for what's happening now, because we couldn't advance more. So I am quite cautious on what's happening in gold right now. Okay, not being blindly long anymore. Not too many reasons to be short of it, but there is a bit of a risk for a remake of this one, I think, right now. Silver painting roughly the same picture. Still tough to get through 30 and stay above 30. Although we're hanging just below, it's a little bit like gold, different speed, of course, in those metals, different liquidity as well. But this is what I'm keeping a close eye on. So I'm not adding. I'm just seeing what happens towards the end of the week. I've got my long term still on, but I was thinking that if I see a move higher, if that's end of month driven, I may sell a few more out and then go to just a skeleton or base position, as I call it. Okay. What else? If you guys want to look at something, just give me a shout. Okay. As I was saying, the rand is one that relatively benefits from what's going on in the dollar as well. We are still below the triangle, trying to get back above, but that was rejected really pretty strongly. If the end of month is as expected, I don't know how much there is to do in the emerging market, but I would not rule out to get a revisit of what happens here. You know, it's just looking like, especially with the expectations on the dollar, it's just looking a bit fragile to me. If we can't retake those high 17s, looks a bit vulnerable. S&P. S&P is is bid. There's not too much reasons to be short of it, right? And especially if the market expects, yeah, Michael, especially if the market expects the Fed to go ahead. Um, interestingly, is that the Fed balance sheet roll-off did not show too much of it the last time they reported. So that is perhaps an additional factor behind the S&P relative strength is that for as long as you keep more liquidity in the system, you underpin the equities, right? Levels, look at for a start of it 55.90, Joao, and then I would say here 55.70 down to 55.5. There should be your supporting coming if we see a setback, and then watch out if we break those prior highs, because then this is probably heading for people are talking about 6,000, right? But one step at a time, probably headed for 58 if we get that break here. All right, that's what I see on the S&P right now. The dollar mix is the thing is, it's a relatively important little level here around 1960, 1970, and then back up to 20. There's not a lot of positives in the mix right now, okay? Yeah, Scheinbaum is trying to appoint a minister to take care of Pemex, but then we have seen those Pemex numbers are absolutely awful for right now, and Mex is one that is we've also seen the data not being that brilliant. So the Mex is one that is a bit your trading the dollar, but in an accelerated fashion. So if the dollar goes down, Mex is going down with it, you know, and especially looking at some of those Mex crosses, they really are not doing very well. So for as long as that goes on, I think any setbacks here, 1920, 1900. You're probably going to find support for potential retest up here. Okay, we need positives to get back into the mix, and it is possible that we get those positives once we will have the handover for Scheinbaum. So, but that's not a month away, Michael. Okay, we don't know what AMLO and Scheinbaum will decide in the meantime, but I think we may have to wait for positives until October in the mix if we are going to get some. Now, Kiwi Cat, whoa, that's an interesting one. I've actually never looked at Kiwi Cat, to be honest, Barbara. So that's going to be a first. Oh, actually, I did. Triangle? Triangle. The Kiwi is still relatively strong. The cat seems to be back on the oil bus for a while now as well. I don't know. I really it's not one of my favorite pairs, but if you get up to 84, 70, 85, the figure, pay attention. I don't know which side of the coin you are on. And we're turning around the somewhere. I'd call this is a bit of a traffic zone we were in, so a bit neutral here. I don't know about Kiwi. Kiwi is still looking relatively strong, and caddies as well right now. But I don't know. Really, I have no strong feeling on that one. Looking at this picture, to be fair. No, I'm not going to say much on this, Barbara. I don't know what you're thinking about it. If you can tell me in a few words what you're looking at, that would be great. As I said, 84, 70, 85 the figure. That's going to be a bit of a zone. And then on the downside, you're looking at probably somewhere around 82 three quarters and 82 the figure if it starts to come back down. General feeling, as I said, Kiwi still strong. Data are average. I'm not going to say that they are weakening too much, but they are you're looking to buy. Okay, looking to buy Kiwi Cat. Okay, let's have a quick look at what's happening in the dollar cat. So we've broken down on the dollar cat. We're around a bit of a level here, if you ask me, in the dollar cat. Let's try and freshen that up a little bit. What's happening on the daily here? Yeah, dollar cat still has a bit of a hole below here. If we start to break, okay, 134, 134.30, 133.70, 75. If you see a sell-off in the dollar cat, perhaps down to 133.40, then look where your Kiwi cat is at and where your Kiwi dollar is at. Because Ryan was showing the Kiwi dollar is 62.5 and stuff. I think you have to look at both the dollar pairs to form a better idea on the Kiwi cat. That's the best I can say about that right now, Barbara, because I don't have a very strong idea. And if you look at the price action, we are like kind of going up and down. But if you think about Canada picking up a bit of weakness, sooner or later, look also at oil if oil starts to turn around. And oil, talking about it, we are, well, we went relatively close to the 200 DMA on gold, on oil, sorry, and then just above 78 bucks. That I think is going to be a relatively important zone here, because we have seen most of the big spikes that we saw in oil found resistance at some point, and then we started to come back. Okay, SPR has been filling up reserves as well in smaller amounts. Then we have the geopolitical risk, of course, but every time we get up to reasonable levels here, and we can see that here, we tend to find offers and then gradually start to come down again, and that may be some guide as well to what's happening in the Canadian dollar, perhaps. And with that, Ryan, I'm done. Back over to you, my friend.
Thank you very much, mate. I do want to grab the screens back quickly, because just while Kay was talking about cable, I was having a little look around. I want you guys and girls to do some homework, because what I want you to do is, if you've got charts that you use, I want you to get another one, a copy one, and keep it fairly blank. The reason being, while Kay was talking, I'm looking at some of these wider charts, monthlies, and we've got a lot of moving average action happening here at the moment. Just taking cable on the weekly, we've had this move above the 200. That's an area that you want to be looking at if we manage to get support. What you tend to find with these larger moving averages is it does respect it quite a lot. You know, you get a bit of messing around, then when you're above, it holds it. And you get these little bit of action now. Obviously, you can get some big spikes through this. So what you want to do with this is add it in with your shorter time frames thereafter. So keep an eye on this, you know, like the 128.70, which was a big level on the way up, as you can see there. So match this in with some of your levels on your short termers. The reason I'm saying do this is because we're, particularly for some of these weekly and monthlies, we're getting in to some of these levels that we haven't tested for quite some time. So you can see we've got a bit of a confluence, the 55 and the 100. If we get above that, which we haven't been properly since way back in 2008, so if we manage to push above that and hold it, and we're close to closing the month above it, that could be a very strong support point into there and the 55. So there's a lot of these. Now we've seen these legs up. We're seeing quite a few pairs. We're getting into the zone of some of these bigger moving averages. And you need to pay attention to them. As I say, plot the levels, know them. So if they match some of your shorter term levels, it's a bit of confluence to trade against if we're seeing some of these big ranges breaking. Okay, so that's your homework for today. Get yourself some nice clean charts, very little tech on it. Go for the bigger, wider tech and see where your big levels are popping up, and use them to match off with your short-term charts. And on that note, we shall call it a day. Thank you very much. We'll see you all tomorrow. Have a good one, everybody. Cheers, Kate.
Cheers, mate.